Good morning, Accounting 2, folks. So I got a question this morning from a student who's having a little bit of problems with assignment number 9 and 13. So I thought I'd just make a quick video kind of going over a little bit of those things. I don't have the ability right now to screen share, so you're just going to have to read along with me. On number 9, it's talking about inventory systems, and that's part of the jobs of an accountant is that you have to help with inventory. And inventory is a huge part of accounting because it gives a picture of how much money you've spent, how much money you anticipate bringing in, and how much money you have in merchandise that's just kind of sitting there. So one of the ways that we do that is we can calculate your inventory by using a couple of different methods called Fifo and Lifo are two of the big ones, which is first in, first out. That's what Fifo stands for. And Lifo stands for last in, first out. Those two things, how you do Fifo and how you do Lifo, are entirely dependent on the items that you're selling. So, for instance, something like milk. If a store gets milk in, well, as the milk is being carted in, it gets put into the refrigerator at the back because they want to sell the stuff that was already there. They want to get rid of that first. So that would be first in, first out because, the milk that came in April is still there. That's got to go before the milk from May because that stuff is going to expire. So that's one of the ways that they do it. And also there might be cost differences as you get in different inventory, even though it's the same milk, depending on how milk is produced and different changes, the price may change even though the item has not. So that's another way that we kind of use the inventory systems to take a look at that. The other thing might be last in, first out, which would be potentially clothing. Let's just take a look at clothing. So if summer's coming up, bathing suits or something right now, that would be, if a store gets an inventory of bathing suits, they want to put those out because summer is coming up. Even though winter jackets might have already been there, winter jackets are going to kind of get pushed to the back. So there's a couple of different ways. So even though swimsuits might be the last thing in, they're going to be the first things that are going to be sold. So different industries do this differently. It all really depends on the products. And also there's a method of averaging as far as your inventory if something comes in. If the price changes, you average those things out. So if I get an order of coffee cups and I order the same coffee cups year after year after year, but the price steadily changes, the average method is something I could do to average out how much I paid. So from least expensive to most expensive, and kind of give me a picture in the middle. So that's really just what Chapter 9 is all about, is talking about the different inventory methods and the periodic perpetual inventory and keeping track of those things. And in your book, it's actually chapter, boy, I had it right in front of me too, chapter 24. So it goes over the periodic inventory system, FIFO, LIFO, everything that you guys would need to be able to answer these 6 questions. All of that is there. There's some easy stuff in here too, like using accounting terminologies. That's going to be pretty simple to be able to do that part. So that's as far as number 9. That's a fairly easy one. Now number 13 is a little bit trickier because it's explaining the issues related to accounts and notes receivable, and it talks about completing journal entries while entries to write off uncollectible accounts using both the allowance method and direct write-off method. So there's a couple of different ways to look at this, and basically what they're talking about with uncollectible accounts would be accounts that never got paid. For whatever reason, if you were a supplier and you sold something to a business and they bought it on account and then they went out of business and you just never got your money back, that's a loss that you're going to have to account for, and that's just what you're going to have to do. So there's a couple of different ways to be able to look at that, and if you go to chapter 23, they actually talk about some of those uncollectible accounts and the direct write-off method, which is just basically writing it off as a loss and subtracting it out of the special journal. So that part kind of, once you read through it and you kind of get the understanding, because if you have a loss on an uncollected account, that has to be put somewhere. And then the next question becomes, when you put that loss in, when do you put that loss in? if this was an account from a year ago, would you go back and change last year's accounting statements to reflect that loss? Well, it's probably not a great idea to go back and change historical things, but you may have to put that on this year's. And so that's really what they talk about as far as the allowance method, the write-off method, and some of those different things as far as how they work, because it does matter when you do those things, when you know that you're going to be taking a loss on something and you have a way where it's just not going to be able to be collected. So that's a lot of the stuff on chapter 13. It's really just chapter 23, chapter 24 in the book. If you guys are having trouble finding chapter 23, 24 in the book, let me know. I got some ideas on how I can get you a chapter and get you the book. So email me, show up during office hours if you guys have any other questions. I'm hoping to have this whole thing hopefully wrapped up by Friday of this week. And next week is going to be a lot of just finalizing grades and things like that, and hopefully we can be kind of done around May 22nd. So if you guys have any other questions, give me a shout. Let me know what you think. Thank you.